Hello, good morning. Uh, Welcome to the session once again. Today also we'll continue the basic terms in accounting. This is the fourth session, fourth one. Now I think two more sessions will continue. After we'll go to the practical side of practical accounting for recording transaction and all. So today we'll discuss about the GAAP, Generally Accepted Accounting Principles. We'll go to the slide. So, GAAP, Generally Accepted Accounting Principle. It means the rules, standards, and procedures followed in practice of accounting. That means from recording. Yesterday we have discussed about the five functions of accounting stages: recording, classifying, summarizing, analysis, interpretation, and communication. 6 stages. That means in recording, from first recording up to communication, from up to reporting, we have to follow certain rules, standards, and procedures, mainly in recording and reporting, the first and last, because so many formats or rules are to be followed there. So this is called GAAP, Generally Accepted Accounting Principles. Before going to the GAAP, I want to go back a little the historic background of GAAP. Actually, this started in US in 1929. There was a stock market crash, the huge stock market crash in 1929, after a Great Depression, in not in US only, in throughout the world. You may be heard about, you may be read. If you click in Google, you'll get the information. It is starting and all the reason, and we are not going to that. After that only, US began to think about this GAAP, because the what do you call, the credibility, the faith of the people has gone after this Great Depression. So first US started SEC, that means Security Exchange Commission. The Security Exchange Commission was started, and after that they have started American Institute of Accountants in 1939. American Institute of Accountants in 1939 and Security Exchange Commission. And after that, after the introduction of Security Exchange Commission only, it started, GAAP is established. Actually, you may be heard about FASB, Financial Accounting Standard Board. It is also one of the governing body. That is, FASB started. Actually, FASB started GAAP. It is in 1973. FASB, the GAAP means it is the organized form. 10 GAAP, Generally Accepted Accounting Principle, first introduced in 1973 by FASB. FASB means Financial Accounting Standard Board. And you may be heard about AICPA, American Institute for Certified Public Accountant. That is also one of the important what do you call, professional body, or the standard setter. They first introduced in 1979 10 standards. That is GAAP, introduction of GAAP. So you have to understand this as a small story. 1939, 1929 and 1939, they started already, GAAP is started already, but in an organized form, 10 GAPs they introduced in 1973. It is, I think, yes, it is 1973. It is established. It came for the GAAP. It came an established form with FASB and AICPA, Financial Accounting Standard Board, and American Institute for Certified Public Accounting. These are the two institutions or governing bodies or professional bodies. They started, or the first started the organized form of GAAP. After that, now it is International Accounting Standard, IAS, After that, 1973 itself, in FASB and AICPA in US, but at the same time, IAS, International Accounting Standard Committee, IASC, International Accounting Standard Committee, that means IASC, introduced IAS, International Accounting Standard, in 1973 itself. It is also in an organized form. The standards are introduced based on London. There is first 29 standards. Now presently there is 29 accounting standard IAS, and also in 2001, this IASC, International Accounting Standard Committee, that transformed to International Accounting Standard Board, IASB, and they introduced revised standard. It is called IFRS, International Financial Reporting Standard. So now presently there are total 126 countries registered. Out of the 90 countries are fully incorporated or full agreement or fully incorporated with the standards. So total this IFRS, there are 16 standards now, and IAS introduced by IASC having 29 standards. So IFRS and IAS including 29 plus 16, there are 45 standards now, internationally accepted standard. These standards are accepted by 126 countries throughout the world. Some countries are partially following. Some other countries are fully. 90 countries are fully following. So mainly the listed companies, security market listed companies, they are fully following these standards. So you have to understand 126 countries are following the standard. Out of that International Accounting Standard, that means IAS, and IFRS, International Financial Reporting Standard. These are two standards. IAS is 29 standards and IFRS 16 standard. There are 45 standards. In I think in IAS, in BTech courses, there is a IAS, International Accounting Standard, a separate course. Now it is revised to IAS. So all these 45 standard we cannot study in one course. It is a very lengthy course. So I think 12 or 13 standards we are studying in BTech course one IAS, International Accounting Standard. Anyhow, you have to understand this all as a basics. This the history of this IAS, IFRS, GAAP. GAAP is introduced in US, and it is in organized form. It came in 1973. After that, in 1973 itself, IAS was established by IASC, International Accounting Standard Committee. After that, it transformed to IASB, IASC transformed to IASB, and revised standard introduced by IASB. It is called IFRS. Now we are following. We have the standard in accounting standard. Actually, this accounting standard is very, very important. It is to have a uniform or universal platform. Uniformity in accounting. Otherwise, for example, we are in everywhere, in these 126 countries, everywhere, the system of accounting is same. If you study the accounting in any country, any of this country, you go to other country, you can practice. Why? Because uniformity. This uniformity or uniformity in accounting is enabled because of this GAAP, IAS, and IFRS. So we should have to understand a little about which are the different standards, what are the things, and all we'll discuss one by one. So now we are not discussing. We are not going to IFRS and IAS. We are discussing about the GAAP standards. So this is the definition. First, two meanings. In GAAP itself, it is divided into two categories. One is accounting concepts and accounting conventions. Accounting concepts and convention. And 14 concepts are there, and 3 or 4 conventions are there. These arbitrary. Some authors tell it is 4 or 5. There are some arbitration. We are studying 14 accounting concepts and 3 accounting conventions. And now we have to understand what is concept and convention. Actually, the concept you may be heard about. First, principles, it is accounting GAAP principles. Principles means mubadi, the basic fundamental principles to be followed in accounting. This is called GAAP. And after that, there is a concept. Concept, it is actually, it is fakra, concept, or mafahim concept. So this concept, and also the convention actually it is called arf or ittifaqiyya, convention. So these two terms you have to understand, or tradition, taqlid, I think taqlid, tradition or taqlid. So these all were the principle, concept, convention, tradition. This in this slide you have to understand forward. Principles means mabadi, the basic rules or principles. Then concept means mafahim, that means its concept to be followed. And convention means tifaqiyya, the agreement or the convention, the followed, traditionally followed rules and regulation or agreement. Then tradition or taqlid. So these all terms you have to understand. So first you will go to the definition of concept. Accounting concepts are basic assumptions and condition upon which the science of accounting is based. So assumptions and conditions. In accounting, there are some assumptions and conditions to be followed. There are some assumptions, some beliefs, or some conditions. So it is called the basic principles or concepts. Another is convention. Convention is a little different. The convention is include those customs and tradition. Traditionally, we are following some customs or tradition. We are for long years. We are following some traditional methods. That is also called convention. So accounting principles means include both the concept and convention. 14 concept and three conventions. So we'll discuss about one by one. We are not going more detailed. For example, you can understand this. What is the principles? Principles, the meanings are rules, standards, and procedures followed in recording and reporting of accounting. It is what is the basic idea of this? To have a uniform platform or uniformity, to bring the uniformity or consistency in accounting practice. So that you have to understand. After that, you have to understand there are two types of GAAP principles. One is accounting concepts, another is accounting conventions. Now we'll go to the one by one. We'll try to discuss the accounting concepts or principles. Concepts are both are principles. Concept and convention both are principles, but most often concepts are alternative term used for concept is principle. The other three conventions. So first we'll go to the we'll go through all these concepts once. I'll just read. Business entity concept, money measurement concept, dual aspect concept, cost concept, accounting period concept, going concern concept, and revenue realization concept, full disclosure, matching concept, materiality, and objectivity. These are the 14 concepts. And also we have three conventions. They are conservatism, consistency, timeliness. In different others have different opinion in this. Some are tell this full disclosure is also a convention, but we are not going to that arbitration. We have 14 plus 3. So 14 plus 3. So we'll go to the one by one. What is business entity concept? It's a very simple concept. That means business, one side the business and the owner, businessman, both are separate entities. This concept, business is separate from businessman, not same. Business have business on assets, liabilities, incomes, expense, equity, all separate. Businessman expenses, his assets and revenues or incomes are separate. Like business and businessmen both are separate. According to this definition only, according to this concept only, we are making in the accounting part. We are not just going with just for example, when we start business, we'll make an entry: debit cash or bank or any asset. Debit. Suppose if you are bringing cash to the business, debit cash, and credit capital. What is the meaning of this? Debit, what comes to the business, or cash is increasing, that is why you are debiting. Then credit, the giver, or capital is considered as credit aspect. It is considered as internal liability of business to businessman. When businessmen bring the capital and invest in business, so business obliged, or business it is the liability of business to repay this cash to businessman. So businessman is considered as a creditor, as a third party, or we can tell it is a second party. Third party is external creditors, we can tell. This is an internal creditor. So this is the basis of on the basis of this business entity concept only we are making this entry. So business is separate from businessman, not both are not same. So business, if you take money from business, that means for your personal use it is considered as drawings. Your capital decreases. If it is both are for you, if you take money, it doesn't matter. But if you withdraw money for your personal use, your capital, your total equity or capital, the business decreases because of this concept. So this is one of the basic concept, business entity concept. Business and businessman both are separate entities. Their assets, liabilities, revenue, income, and profits or equity or capital, everything different, separate or distinguishable. So next is second one is regarding the money measurement concept. Money measurement is also very clear. Money measurement in regarding to reporting all the transaction, monetary transaction which can be measured in terms of money can be recorded. So in your financial statement, non-monetary transactions are not recorded and reported in your financial statement, but you have to show as a notes, as a separate notes. You have to show non-monetary aspects also. If there is anything any material facts are there, you have to show in your statement, but it is not included in your accounting recording. After all this process, it is not included. Only money measurement, the activities or transaction which can be measured in terms of money are recorded and recognized. So first thing is that first stage in business accounting cycle is identify the transaction. You have to identify which is the transaction, which are the business transaction, which are the transaction related to or monetary transaction, like that you have to identify. So this is one of the second concept or principle. Then third one is regarding double entry aspect or dual aspect accounting concept, or dual aspect principle or concept, or it is also called double entry principle. It is the basic principle, fundamental principle of accounting. Dual aspect. For every transaction, there will be two aspects, one debit and one credit. For every transaction, two accounts will be related. One debit aspect, that also for every debit there will be a corresponding or equal credit or debit also. For every debit there will be a corresponding and equal credit. So then only the accounting, double entry accounting will be followed. We can apply the double entry principle or double entry accounting. So it is very important for every aspect. It will go when this already last session we discussed about accounting equation, asset is equal to liabilities plus capital. There when we are discussing asset, how this equation is derived from this principle only. For every debit there will be a corresponding credit. That means asset is equal to liabilities and capital. For both sides there will be debit. Then debit and credit, when we are discussing, it will take it will go. That we'll discuss when we are going to the rules of accounting. Another session will discuss the rules of accounting or the rules of journalizing. How to record transaction in the books of account. You have to follow certain rules. At that time, we will discuss in detail. Now you just have to understand there are for every debit there will be a equal and corresponding credit. For every transaction, for every event in business. So this is dual aspect concept. Then another, this is all, almost everything is very clear from the term itself. Historical cost concept. Historical cost concept. Historical cost is very important. The cost concept is to be followed for recording transaction or for reporting transaction. Actually, this all the this what you call concepts and conventions are directly recorded with recording and reporting, tasdeel and communication, tasla. So in this area, you have to understand. We discussed already the 5 or 6 feature stages. So historical cost, what is it saying? The cost, the original historical cost is to be recorded. Cost of the asset. When you are recording the transaction or recording an asset or anything in the business, the historical cost is considered. The cost at which you, or the historical cost also called acquisition cost. The cost at which it is purchased. Acquisition. Plus the freight, installation, insurance cost, like all the cost of installation. This is all called the historical cost or cost concept include all this historical cost. Historical cost include cost of acquisition. You buy one machine, for example, you buy one machine from market or from some company and bring to your site. So carriage, freight or carriage inward, plus installing that machine, installation charges or installation cost, and if there is any insurance for the machine, it is also added. This is total cost. That cost is recorded as the original cost of the asset. From that, you have to calculate the depreciation. So second year, if it is, suppose you bought one asset for 10,000 riyal, and for installation, for freight inward or carriage inward, installation, and all these things, installation, carriage inward, insurance, freight, all this including this are coming on 5,000 riyal. So 55,000 riyal. So first year, the 55,000 riyal you will record in the business as the cost of this asset or machine. Then first year, if the machine can be used for 10 years, you will depreciate. You will charge depreciation for this 10%. The 55,000 into 10 by 100. So 5,500 first year expense because of machine. We will write off as depreciation. That all we will discuss, because we didn't discuss depreciation. The depreciation is a decrease or diminishing the value of asset by usage, or it is called in Arabic, it is called istihlak. So that we will discuss later. Now you just understand the acquisition cost is important. Here one example is given here. For 1 million riyal, for $1 million, you buy a building. A big building, a huge building you buy for 1 million riyal, dollar you paid. After few weeks or month or few years, the value of that building is the present value or market value of the building is, or the saleable value of the building is 3 million. But you have to record only 1 million according to the historical cost concept. You cannot record more than 1 million. Even though you buy something the same day, the market price of this asset is more than that, you cannot record. The market price or saleable price or any other price is not considered. You have to record the transaction in the books of account at historical cost. It means acquisition cost or cost of acquisition, purchase cost, plus freight, plus insurance, plus installation charges for building or for installing this, for installation of that building or machine, you have some charge. That also you included. Then you have to record. No other cost or market price or market value, saleable price is not considered. So even though this is a good example, even the 1 million you buy that after 3 years or after 1 year, the value of it is guaranteed. 3 million is the value of that building. It is because of you generated good image or goodwill or reputation or brand name you made. Because of that, it doubled the price. But you cannot record in the books of account. In the balance sheet, in your balance sheet, the price, it should be true and fair. Disclosure of the figures expressed by balance sheet should be true and fair. So it should be historical cost. That is another principle or concept. Then another is accounting period assumption. Accounting period is a very simple period. So period, whenever you are considering the period, it may be for quarterly, 3 months, or half month, or for a 6 month, half year. So 3 months, half year, or 1 year. If you are preparing 3 months quarterly financial statement, for the expenses and the incomes you have to take for 3 months only. You cannot take 3 months expenses and 4 months or more than 3 months incomes. Then comparison or your profit will not be correct. So according to this, normally the accounts or the financial statements are prepared for 1 year, as you know. So it is yearly, annual account. So this is, you have to follow that. Here you have to, for this accounting period assumption, one of the things you have to be very careful, that accrual concept. In accrual concept, for example, there may be some, for example, this first 6 months you sold goods, but cash is not received. So sales, how much you sale you made, that's also can be considered as your income. But expenses sometimes may not be paid. You due but not paid may be there. That also you have to consider. That it's all the what you call accrued expense, unearned income. These things all we'll discuss later. Now you have to be very clear about the accounting period assumption. Accounting the split of the period is you can make quarterly or half yearly or yearly. Annual financial statement can be prepared. Another is going concern assumption. Going concern. This is another assumption. Going concern assumption. For example, this is always when you are doing the accounting in recording and up to reporting, from recording to reporting, always you should follow going concern assumption. It means the company or the business will be continued for a foreseeable future, for indefinite period, will go ahead. The accountant, if as an accountant you have to think the business will be continued for a foreseeable, this the term is used, foreseeable future. That is very important. That means foreseeable. That means you can predictable future. It should be maybe a few years. It will continue. For example, 10 to 20 years the business. Suppose this is a very you'll find it if you go to the in depth. It is very easy to understand. For example, you have the business. You have, for example, your one of your asset, one machine you purchased 3 years back, or car. Suppose it is a car, is an asset you purchased 3 years back. After depreciating, you are depreciating 10%. 10 years you can suppose approximated life estimated effective estimated life period is 10 years. So 10% every year you write of depreciation. So now the car you bought for 10,000 real. Straight line method, every year 3,000 real you reduce, you write off as depreciation. So 5th year the car value will be 5,000. That means 5,000 already you reduced. So 5,000 is the value of car according to your book. But you know already, if you sell the car today, you'll get only 2,000, or 5 years you used already. Maybe the value you may get 3,000 real. You can sell it. But the value, it is on the assumption that the business is not going to cease, not going to liquidate. It will continue for an indefinite period. Then you can use that. So till 10 years, you will continue the business. If you are continuing the business 10 years, it is okay. Every year 1,000 decrease, and 10th year you will get the scrap value, or 9th year you sell it for 1,000. So you will get, there is no any problem. So you need not think about if the the car is sold now, you will get only 3,000. So why I show the balance sheet, why I show it is 5,000? Because depreciated written down value is 5,000. 10,000 minus 5 years, 1,000 each depreciated. Now it is the present written down value is 5,000. But you have to show it is 5,000 on the assumption that the business is not going to liquidate in nearest future. It will be continued for a foreseeable period, years, number of years. So this is one assumption. So this all assumption, or what you call concepts or principles. That means you have to follow this. You cannot think that 3,000 and that comparison should not be there. This is a very important concept in accounting, going concept. It's called going concern concept. Another accounting concept is revenue realization concept. This is also a very important concept, revenue realization concept. Revenue realization. That means this is very important to understand. First you have to understand there are two approaches, two bases in accounting. One is cash basis, another is accrual basis. Most of the accounting, most of the business firms are following the accrual basis of accounting. Almost except one, I think because it is a tax authorities or international accounting standard or tax authorities all approves accrual concept. But cash concept is also using, but some exceptional cases. For example, that all little advanced, but I just spell out those occasion where you follow the cash basis. For example, the cash flow statement. When you are following cash flow statement, when you are preparing cash flow statement, cash basis or approach is followed. Also, when you are non-monetary institution, that means a non-financial institution, like any non-financial, they will make a receipt and payment account. They have income, and in place of profit and loss account, they have another income statement. Another income statement is called receipt and payment account and income statement. They will make a receipt and payment. Then while preparing receipt and payment account and while preparing cash flow statement, we are following this approach, cash approach. Cash approach, but you should be clear what is the approach. Cash approach means cash is or transactions are recognized and recorded when cash is paid. Expense are recorded when cash is paid. Revenues are recorded when cash is received. This concept we are not using anywhere. We are using accrual concept. So accrual concept was, what is that accrual concept? The accrual concept, revenues are, here it is very clear, revenues are recognized or recorded when it is earned. Goods or services you will record as income. It is considered as income, accounted or recognized or recorded as income when it is earned. That means sale is made, service is provided, you can record as income. No need to wait for getting money. Cash basis, what? Revenues are recognized or recorded when cash is received. But just by sale or providing service, you cannot record the transaction as income in cash basis. So this is this seems to be a little difficult, but it is very easy. Then next one is expenses. In cash basis, what is said? Expenses are recorded or recognized when expenses are paid. It is cash basis. All the expenses you will record or recognize when it is paid. When it becomes due, you will not record. But in accrual basis or in normal case, what we are preparing financial statement and everything, in recording to reporting, we are following the accrual principle. In accrual principle, tell what? Accrual concept tell what? Expenses or losses. Expenses, revenues means profit, income, revenues and income. Expenses and losses are recorded when it is incurred. You incurred an expense, it become due, then it is to be recorded. For suppose the rent, this is the first day of a month, rent become due. So when rent become due, it can be recorded. Maybe you are paying the rent in next month. So In accrual system, you cannot record in next month. It is the income of this month. It is the expense of this month, not next month when you are paying. But in cash basis, the expenses are recorded when it is paid. So this is once again I will explain. According to according to the revenue realization concept, you have to think about two approaches, two basis of accounting: cash basis and accrual basis. In revenue, for example, in cash basis, revenues are recognized and recorded when it is received. And in accrual basis, revenues are recorded or recognized when it is earned. Earned means when you provide the service, when it becomes due to you, when the goods are sold, it is your income. Then in case of expenses, in cash basis, expenses are recognized or recorded when cash is paid, or after actual payment is made, only you can record. When it becomes due, you cannot record. But in accrual concept, expenses are recorded or recognized when it is incurred, when it becomes due, or when you spend the expense. It means the best word is when it is incurred or when it is due. No need to wait for actual payment. Actual payment sometime may be next year, but this is the expense of this year, because this year it become due or you incur the expense. This is a very, very important concept in accounting. You have to follow. I told you this is all the authorities, tax authorities, international accounting standard, IFRS, IAS, all these professional bodies are most approved basis, most accredited basis, accrual basis. But in some exceptional cases, we are following cash basis. That occasions are: one is while preparing cash flow statement and while preparing income receipt and payment account, not income and expenditure account. That is, you are following accrual basis even in non-financial institutions. So these are the things relating to revenue realization concept. Now we'll go to the full disclosure principle. Another is full disclosure. It's very clear from that all the material facts are to be disclosed. Everything you have to disclose. Full disclosure principle is also a very important concept in accounting. Full disclosure. All the material facts relating to, when this is mainly applicable to reporting. While reporting means while presentation of financial statement, that it means income statement, balance sheet, cash flow statement, and statement of changes in equity and other notes. These are according to international standard IFRS, International Financial Reporting Standard. These are the 5 reports included in financial statement. But there are so many other statements. You can include trial balance, you can include fund flow statement, you can include other statement, bank reconciliation statement. So many things you can include as financial statement. But according to International Accounting Standard or IFRS purview, there are 5 documents, 5 statements. Once again, income statement, statement of income or profit and loss account, and balance sheet or statement of financial position, and cash flow statement, and statement of changes in equity, and also the last one is the required notes, additional notes, footnotes or additional notes should be attached. So these are the things. So all this to be disclosed. All the material facts, you cannot hide or you cannot conceal anything from your financial statement. For example, even here you have to understand, even there is non-monetary, for example, contingency liabilities or contingency asset, you can mention in balance sheet. In footnote, not in figure. For example, an employee you are dismissed this year because of some reason. Against the dismissal, he went to the court and filed suit against the company. But there are chances after 1 year or 2 years, the court may decree against you, and you may have to pay compensation for that employee. You know that. In that case, it is a contingent liability. Contingent liability means that we didn't discuss that much in detail. We didn't discuss the liabilities. The contingent liability means it may and it may or may not be a liability, an obligation of the business in future. Now it is not a liability, but after 1 year, if the decree comes against the company or in favor of the employee, you have to pay at the time legal claims. So for that, you can keep some money or the provision for that, for legal provision for legal compensation to employees. Like you can make a provision and keep for that. Suddenly, if it is a huge amount, if you have to pay next year, you will find crisis. So if you know it is almost sure, you can keep the provision for that. Set aside some money from your profit. That is also to be done. So now we will understand everything. That means full disclosure, all the material. Then the material fact also very important here. The fact become material. All the facts, all the things are not material. Some facts, that means material fact, it's a very important concept to be understood, concept you are doing. But we have another principle, materiality concept. There we'll discuss more detail. That means any fact which may influence the decision of the investor. For example, because of one mistake you have done in financial statement, for example, a small mistake, you didn't keep provision for bad debt, or your depreciation is underestimated, undervalued. So depreciation, you have to charge 25,000 for a particular asset, so you charged only 10,000, so 15,000 difference. If you charge this 15,000, profit will go down 15,000. So whether it is material or immaterial, how do you know? How do you check? If the decision of investor, so the potential investors are investing money or investing money in your business or buying the shares of your company, because on the basis of the analysis of financial statement, at that time, if this 15,000 your profit is less, if it affect the decision of investor, if we know this, because of this your 15,000 profit is less, if we know this, if he change the decision, he may change the decision. Normally, if it is slightly affect your profitability or financial statement or assets or liabilities, it will not make a decision. It will not lead to change the decision of investor. So if the decision of investor is changed, or it may have a possibility to change, it is material. Otherwise, it is immaterial. So full disclosure till all the material facts are to be disclosed. So small for contingency liability will tell you, if it is a very small amount, even though it is not disclosed, no problem. For if it is material, you have to disclose. In auditing or before auditing, you have to, in audited report, it should be there. So this is the full disclosure. Now another concept is matching principle. This is also a very important principle. Matching. That means comparison. That means you have to match. Expenses and revenue should match the same accounting period. It's very clear. The expenses, you took the expenses for 1 year, 2019, from January to December. Then the incomes also, the probable incomes you are taking also, it should be from January to December. It should not have any income that belongs to 2020 January or February. You cannot include. If you include any income, for example, any income which belongs to 2020, you include in 2019 balance sheet, and you minus from that all the expenses for 2019, only your profit, difference of profit, the difference between revenue and expense, the profit will be there. Profit will be different. Profit will be increased or decreased. If the revenue is more, profit will be more. If the expense is more, profit will be less. So like that, you have to make the expenses. This is very important when we are when we are discussing about the concept. I know this is accrual concept. The cash basis, two bases are being discussed: cash basis and accrual basis. In accrual basis, it's important, but in cash basis, it is not. That there is no importance for this. Why? Because in cash basis, when the revenues are recorded when cash is received, earnings are You receive after receiving only you will write. Then next year, after receiving, next year income, if you receive now, you can record. Like in expenses, you will record after paying only. So whenever it is paid, you will record. You are not thinking whether it belongs to this year or whether it belongs to next year. But in revenue, in accrual concept, if any expense is paid, that, for example, advance is paid. Insurance premium you paid advance for 1 year. 2019 and 20 you paid 1 year advance. So in 2019 balance sheet or the income statement, you cannot debit this expense that or insurance premium that belongs to 2020. It will not be recorded here. You have to, from total insurance minus that 2020, you have to minus. Then only the expense that belongs to this year you can record in this year. So that is called the revenue, and expense and revenue should match. Then only you will get what you call consistent or the true and fair profit. If the profit is wrong, your balance sheet or financial statement will not be true and fair. The ultimate aim of accounting is to present a true and fair financial statement and profitability statement. That means income statement and balance sheet. It should be true and fair. So this is a matching principle. Your revenues and expenses should be matched. So I told this concept is not much relevant in cash basis of accounting, cash basis. Then another is materiality. Here we will discuss more about materiality concept. Materiality, I told you, it is materiality, and also it is we'll discuss more about materiality. That means whenever it is also there is something else you have to understand. Some companies are deciding materiality. For example, 5% of that also we'll discuss. So materiality concept is normally it is like, for example, materiality will be for example, I told you if it is material, if material means if it affects, if it influences the decision of the investor, if the fact or whatever the recording or reporting, whatever you are doing, if that incident or whatever the event, if it affect the decision of the investor, change the decision of investor, it is material. I told I made a small mistake in accounting. For example, depreciation or in any method, FIFO, LIFO, in stores, inventory control, anywhere, you made a different different methods you are following. That means last year I followed depreciation straight line method. This year I changed it to diminishing balance method. There are different methods of charging depreciation that we'll study later. So because of these changes, shifting from straight line to diminishing method, depreciation volume, amount of depreciation has gone or came down. 2,000 real difference was there. So when the depreciation or any expense comes down, your profit, net profit will increase. So net profit, because of this shifting of method of depreciation from straight line to diminishing method, your profit has decreased to up to 2,000 real. Increased, because decrease in depreciation made an increase in profit of 2,000 real. So investor is checking this on the basis of he is analyzing. Suppose I'm an investor, prospective investor or potential investor. I have 5 companies in front of me. I want to invest. I want to select which is the best company on the basis of profitability and liquidity, consistency, solvency, turnover ratios, and market ratios and operating ratio. All these I calculate. I decide one company. The C, A, B, C, D, E. Out of that, C is the best profitability or liquidity in any factor. Almost all the majority of the factors are good. Then I decided to invest in that company. Suppose after that I knew that this company's profit is because of this shifting of depreciation, this 2000 profit has decreased. So it won't make any changes in my decision, because the nature and quantity of the fact, the amount is considered. What nature of the amount and quantity of the quantity is less, so it may be irrelevant. So it is immaterial. In I will tell another thing. In some companies decide that 5% are material, 5% of net assets, everything, anything, or 5% of net profit is material. What is the meaning of that? For example, net asset 5%. So anything which amounts to 5% of net profit, net asset is material. So I made some mistake or something, because of this the profit has gone up 25,000. My net asset of the company is 5 lakh, 500,000. So if it is 500,000, half million, 500,000 or 5 lakh, how it will affect? This is 25,000. How much you have to check? How much percentage it will come? 5 lakh, 10% is 50,000. So 25,000 is exactly 5%. So if it is 25,000, amount of changes in profit is 25,000. It constitutes 5% of the net asset. So it is material. But if the mistake occurred because of this is 20,000 or 10,000, it is immaterial, because it does not constitute 5% of the net profit. Like that also some companies are considering. So the mistake is whether it is material or immaterial. Material mistake is very big mistake. It is to be reported in auditing. Next, this year, if you made material mistakes, it should be reported in, it should be included in audit report. So you should be, all the material facts should be disclosed, or materiality should be decided. So this is another concept. In materiality, so many other meanings in vast, it is a vast concept. There are some other meanings also, but will that much only the very important things only consider. So now we will go to the next, objectivity concept. Objectivity. Accounting records based on objective evidence. For all your transaction, or even whenever you start recording transaction, journal, recording transaction, the books of account, all records, first when you are recording in journal, the transaction should be supported by documentary evidence, and also the documentary evidence should be objectively made. Objective means without any prejudice or bias or any, what do you call it? It should be objective, unbiased, without any influence. The evidence should be objective. So all the records, when you are recording the transaction, the books of account, all the transactions should be supported by documentary evidences, objective documentary evidences, relevant or reliable, objective. That's also one of the very important concepts, objectivity or objectivity concept. So this is objectivity, mainly free from bias. That is very important. Evidence, verifiable evidence. Then also it is verifiable evidence should be there. So that is objectivity. Objectivity, independent valuation should be there. So valuation of closing stock or valuation of asset should be independent and objective, verifiable. It should be verified. It should be supported by documentary, genuine, or what do you call, valid documentary evidence. All the transactions. So it is called, normally it is called voucher. Voucher may be of all the documentary evidences are supported by for the transactions are called vouchers. Vouchers may be invoice, cash receipt, or bills, or bank deposit receipt, or anything, bank statement or check slip, check counterfoil, or any type of voucher should be there. That voucher should be verifiable and it should be objective, unbiased. So we'll go to the next accounting convention or practice. Prudence is also a very important prudence concept or conservatism. Conservatism or prudence concept. This also you have to understand most of the cases prudence. It's very easy to understand. Prudence or conservatism, you should be little conservative. Mainly it affects profit and losses. You can see profit and losses. When you are recording profit, the anticipated profit you can leave that. Anticipatory or anticipated profit, expected profit or estimated profit or estimated income, you need not give importance. But in conservatism or prudence concept, you have to be taken into consideration. Estimated or anticipated or expected losses should be given importance. That is very important. That means all the expected losses or expense you should consider. At the same time, expected profit, not actual profit. Actual profit, if it is recognized, it is to be recorded. But expected or estimated or anticipated profit, contingent profit, it may or may not arise like that. If it is in that situation, you don't take into account. This is a account, one of the most important accounting prudence concepts. For example, we can check, for example, stock, valuation of stock. Valuation of stock, how do you are doing? There is, for valuation of stock, the principle of valuation is stock, closing stock or stock is valued at cost or market price, whichever is less. Your stock valuation today, you valued the stock, the value of stock is 60,000 riyal. It is actual valuation according to the books of account is 60,000, but market value of the stock is 50,000. According to this concept, you have to write 50,000 only you can record. Closing stock value is only 50,000. You cannot record 60,000 because the stock, closing stock or inventory is valued at cost price or market price, whichever is less. Your actual cost is 60,000, but the market price, saleable price or market you can buy at 50,000. Now this stock, so 50,000 is considered because expected losses you have to give importance. But at the same time, if the market price is 75,000, your actual stock value is 50,000. Actual stock according to your acquisition price, the cost of acquisition or historical cost after actual cost written down value. Now the present value of the stock is 50,000, but actual market price, saleable price is 75,000. You cannot record that. You have to record 50,000. You have to take into consideration only 50,000. This is the case. That means expected or anticipated profit or increase in stock you are not considering. But when there is an expected or anticipated, what you call decrease in stock, you are considering that. Just like you can see valuation of stock depreciation or provision for bad and doubtful debt, all these things. This provision for, why you keep for provision for bad and doubtful debt? You sold goods on credit this year. 35,000 riyal you sold goods on credit. The amount will be collected next year. So when you collect the amount, there may be some decrease, some doubtful debts, some bad debt may be there. Some people may not pay the money. So for that you are keeping provision for this year, because this year credit sale you taken as an income of this year. So if there is any expense when it is realizing next year, recognizing next year, but it belongs to this year. Why? The sales is considered as an income, credit sale. So this year's income you have to consider. This also, while all the cases, stock valuation, depreciation, bad and doubtful debt, all these cases we are applying this conservatism. Anything like that. Contingency, I told you before, the employee compensation provision you are keeping. but at the same time there may be chances. In the earlier case, the case may be against the employee, and employee may have to give compensation to you. For that, you are not considering that additional income because of that compensation received in case of favorable decree. You are not considering here. So in every cases, the prudence or conservatism concept you have to follow. Then another is consistency. In consistency is also one of the most important factor. Consistency, your changes, that means you have to follow the consistent uniform pattern. Like, for example, in uniform practice and practice you have to follow, procedure you have to follow. For example, I'll give some example, like for stores ledger. If your valuation of stores ledger stock, there are different methods are there. For example, FIFO, LIFO, first in first out, last in first out, and weighted average cost, simple average cost, highest in first out, HIFO, NIFO, next in first out, base stock method. So many methods are there, but you are following, the company is following first in first out, first stock, first sale. This method you are following. Then you have to follow the same method for a series of years. You cannot change always. This year you follow LIFO, FIFO, next year LIFO, last in first out, last stock to be sold first. You cannot change that. Consistency is a very important factor. If you change, what it will happen, it will affect your profit. LIFO, when you change this method, your stock valuation, the value of stock may be changing because of closing stock changing. When closing stock increasing or decreasing, it will affect your profit. And this year profit, when you compare with last year profit, comparison will not be your ratio, profitability ratio. Your ratios may not be accurate. So because the ratio, this profitability comparison is to be made. The judging the efficiency of the company's profitability is made on the basis of comparison. Liquidity, profitability, all profitability, net sale, for example, net profit by sales in 100, you are comparing with say net sales, and also you are comparing this profitability or net profit ratio margin with last year. If it is affected by this FIFO, LIFO changes, it will not, comparison will not be accurate. So that is why, in many cases, in all these cases, you have to follow consistency. Then also depreciation. If you are charging depreciation, in case of I told depreciation, also there are different methods, straight line, diminishing, machine hour method, and sum of digit methods. Like so many methods are there, depreciation. So if you change this year's last year's straight line method, this year diminishing method, methods are changing. Because of this, your profit will be changing. So comparison will be misleading. So this is also, consistency is to be followed in accounting. Then another is timeliness. This is very simple. The principle states that information should be provided to users at the right time. You have to write reporting, communication, last stage in the accounting function, recording, then classifying, summarizing, analysis, interpretation, and communication, reporting. This reporting or communication, you have to present the financial statement at the right time, because the investor, the stakeholders, not only the investor, all the stakeholders to take decision. They have to take decision on the basis of the financial statement. If it is delayed, it will not be helpful for that timely decision making. So timeliness, the report is to be presented or submitted, or report should be communicated at the right time. And delay in providing serves usefulness of, or the usefulness user decision making. For decision making, if you make delay, for example, the company, the investor want to take decision about whether to invest in which company is to be invested. If you make delay in presenting the report, he will invest in another company. For example, in December 31st, in December or the January 1st week, all the companies' balance sheet and financial statements are submitted to the stock exchange, Muscat security market. Your company is delayed. So someone want to take decision on the basis of profitability. It will not be your statement for this year, current year will not be available. Then they cannot take decision. That is why the rule, that is why the, what do you call, The regulatory agencies are very particular. You have to say within specific time you have to reporting is to be done. So next one. So this is so we have to understand the last three, the consistency. These three. That means prudence or conservatism, and this consistency and timeliness. These three are conventions, other are concepts. So these are the topic to be areas to be discussed in the GAAP. Actually, GAAP is a very big topic. GAAP, generally accepted accounting principle. So I think it is you have got it was useful for you. You have got a brief idea about the what is GAAP, generally accepted accounting principle, especially the concept and conventions used in accounting. Actually, this part is little boring because it is not practical oriented. It is you have to keep in your mind while doing following the procedure of accounting. That is why it is an assumption or concept, tradition, convention. This it is not practically you are not. For example, you studied last session we discussed about the current liabilities, current assets, and so many things like that. The overheads. These are exact terms, but these are terminologies. But these are concepts, conventions, and trend and principles. So in that way, you have to understand. Anyhow, thank you. Thanks a lot.